Hey, good afternoon. This is Ken Long at Tortoise Capital, and this is a review of the quiz from February 10th, 2017. We're looking at XIV, and the challenge was to describe the situation that we see right here at 1:15 in the afternoon in terms of the regression line crossover in order to evaluate that scenario for possible trading opportunities. And so the first thing we're going to take a look at is the time. See if we can get this working here. So it's about 1:30 in the afternoon Eastern Standard Time. So we still have 2.5 hours of time available for an afternoon move. So when we think about time, will, pattern, and money, we have to be looking at what kinds of moves are available in the last 2 hours of the day. If we don't want to trade the last 30 minutes, then we're really looking at what can be achieved in 90 minutes. And really, if you look from 12 to 1:30, you can see there's about a 25-cent net move available in XIV during that time. So the next thing I want to take a look at is the gap. The way I have stock charts set up, the gap is yesterday's close was at the red line, and the gap open was here at the blue line, and so we have about a looks like about a 65-cent gap. That was a relatively large gap in XIV, and so that means that when you have a big gap up, we're expecting a big follow through. So this follow through so far from 64.40 to about 65.25 is only about 85 cents, and so it's only made 1/3 of what we call a range stat move, which is the largest reasonable intraday move that's available. So we haven't seen the biggest follow through yet. There's still plenty of room to the upside or to the downside. We'll cover that when we get to the gap stat. So now I want to take a look at the four regression lines: the 270, the 90, the 30, and the 10. And it's of note that I'm looking at this on 1-minute charts. All right, so the 270 is this pink line. I'm just going to highlight this as we go through. It's been uniformly up all day, and just now starting to roll over. So what that suggests to me is that this move inside here, this pullback, has been enough to begin undermining that positive move up all day. So this is now a significant contrary move. In fact, it has come from a compared to the volume weighted average price here. We had a maximum excursion right about here, and now we've got a pullback to the VWAP. Price has now returned to the absolutely normal, the normal move. So let's clean this up a little bit here. So this move is the expected move from an extreme back to what we'd think of as the long-term fair value. So the divergence of the 270 to the VWAP has occurred, and now price has come back to the volume weighted average price. The fact that this is rolling over to me says this is a natural respiratory pause. This is like the inhale on the way up, pause, and now it's starting to exhale. And so when I think about this from the downside, I take a look at the distance from the VWAP to the 270 is the maximum excursion it was able to make so far during the day. If I draw this line down and make it symmetrical, then it can come back to the low of the day. And then if this fails at the VWAP, where it's trying to find support here, but if it fails through here, then a move down here is a target, and then to yesterday's close would be a target, and that would actually be a large move that closes the gap and would negate this entire move. So that potential is implied. Excuse me. The potential for that move is implied by the fact that the 270 is rolling over. So now let's take a look at the 290. I should say, let's take a look at the 90, and that's going to be this green regression line. Now, I want you to notice that the 90 started off down here near yesterday's close, whereas the 270 was up here by the gap. You get that when yesterday's latest price action was up, and then it in the last half an hour or so, it closed down. So you would get a 270 that projects higher and is not affected by this leg of the move, whereas the 90 will follow that much quicker than the 270 and then start to roll up. And then when it catches back up to the 270, then you can say that the morning gap or in the afternoon sell-off have been discounted, and now it's back to the long-term fair value. So a lot of times when you see an upward move and then a sell-off into the close, you see starting to the 90 and the price coming back to the 270, you can play in that direction. So in this move, we see that that this occurs really in the first 30 minutes, and that gives us an indication of an upward move during the rest of the day. Now when we compare the 90 to the 270, there's the 270 and here's the 90, we see that the 90 stays above the 270 until it comes to here. Now I want you to notice in this spot, I would think of this as leg one, because now the 90, you have the 270 rolling up, and then the 90 crossed, and then came back, and where that rejoins, you now have an agreement between the relatively fast traders and the slow buy and holders on the 270, and for that moment, prices come back into alignment for them. When it did that, it found support, then the next arc was up until such time as we saw the 90 and the 270 rolling over once more. So really, the first leg up, the second leg up, when we're looking at the 90, and the fact that this was a shorter distance up than the first leg up, and that the time frame lasted half as long as this one, gives an indication that that this move up is running out of steam, or that the buyers are all satisfied, that there's no burning urgency to keep buying it, and now the threat of this moving down, now that the buyers are satisfied, there's a real chance for this to be a downward move and to shake out the buyers. Okay, now we're going to take a look at the combination of the 10 and the 30 RLs. So we can see, just like the 70 and the 90, the 30, which is in black, has now reached a peak and is now rolled over and has come out of the river here. So we have, at this moment, we can say we have the beginning of downward trending movement. So the move to the VWAP is normal. To the open is next. We saw another, we programmed that other move for the mirror image of the 270 divergence to here. Then the closing of the gap here. And then that would negate the entire upward move for the day and puts that longer term move at risk. It would take a move below here to suggest that today would have been the first day of a sell-off in the market. Really, we know that it's been up for about 60 days since the Trump election, and it would take this much of a move during the day to really jeopardize that. So the 30 has rolled over. Now I want you to notice the 10, which is in the blue, is starting to get an exaggerated amplitude. So when everything is tightly compressed inside the river here, and you see the Z3 lines pinch, that's sort of the peak moment. Now as this starts to roll over and go down, you notice the 30 rolls over, and then the 10 stays with it, and then as price gets more and more volatile, the swings on the 10 get bigger and bigger, and that's an indication that you have an increasing amplitude in price, because now the channel width is this wide, and that's a sign of increasing trading activity. And because it's rolled over and we've had a nice gap up but only a marginal follow through, then that lends some credence to another potential sell-off. So this is a reason to be willing to trade this on the short side. We're now going to take a look at why we're willing to trade this on the upside, and we'll make that case. Next up, we're going to take a quick look at the VWAP, and what does that tell us in the framework here? So that's the volume weighted average price. That's the real fair value. That's the settling up price by the end of the day that that longer term trading desks are going to be measured against when they're filling orders for their clients. So we look for those moments when there is a maximum divergence from the 270, which we take to be the long-term fair value in the VWAP. That sort of gives you a visual on how much delta there is, the difference between end of the day fair value and what the current price is. And it gives you on a percentage basis, the strength of the traders to move things away temporarily. Now, I want you to notice that the VWAP moved up during the day because of the gap, and you have so much volume being traded. You can see this is the volume bar in the horizontal, a ton of volume built there, and then also a ton of volume here at this price level, and then a ton right in here. So now we have two legs up. And now the VWAP is really telling us that this was originally the fair price. It's now moved up slightly because you have this much volume, this much price action and this much volume. Now notice that the VWAP continues to rise, even though price is declining. And that's because all of these prices are still higher than the previous average price. And so even though price is declining, you're still going to get this momentum from the VWAP as it rolls up. So we're treating this as fair value, and now you can see that when price is here and the daily fair value is right here, that now we're really going to find out what kind of a day it is. Is this the kind of a day where we're going to see a gap up, a move up, a pullback, and then find support at the VWAP and then start another leg up? Or is this going to be the place where that move is finally failed and it's going to recover back to yesterday's VWAP? And that's really the big question. Now, the reason that makes this an interesting trading moment is because you can make an equally strong case in either direction for a significant move in the 2 hours or so that we have remaining during the day. All right, so next we're going to take a look at the range stat and see what that tells us. All right, so the first thing we're going to do when we look at the range stat is consult the daily report, the ETF 30 Tactical Summary. And we're going to find XIV, which is the inverse of the VIX. And we're going to come to the range stat, and we're going to see that that is $2.24. And we're going to see that the frog standard deviation intraday is 60 cents. So a 60-cent move intraday is what we would define as the boundary between noise and signal. And then based on a frog quality number of 2.8, what that says is that a $2.24 move intraday is the maximum reasonable intraday move. I'm sorry, there we go. So XIV 224 is the range stat, and the frog box or the frog standard deviation is 0.58. So a $2.24 intraday move is the maximum move. So it's a separate lesson on how we compute all that, but for purposes of this quiz, $2.24 is what we're looking at. So let's get back to the chart. Now, what I want you to notice is that even on the scale of this chart, we're looking for a range stat move at $2.24 as the maximum intraday move. This yellow box that I've drawn is from about 63.50, let's call it 50 down about here, up to 65.30. So that's $1.80. And I want you to notice then that there's still another 50 cents more to an available move. It's not, I can't even show on this chart. So what we're saying is that a move from the low of the day, which we place right about here, the move from the low of the day to the high of the day is really is right about half of a range stat so far. So this is absolutely not an unreasonable move already today. So what that tells us is that if price were to collapse from here, we would take our range stat box, hang it from the high of the day, which is approximately here, and we would realize that we've got another even getting down to this to the closing of the gap, that there's still plenty of room for this thing to fail. So a downward move is still possible. On the other hand, if it does find support at this level, you know, if this VWAP holds right here about 64, 60, what's that? 64.60. Yeah, right around 64.60. Then we know that the low of the day, which is about 60, let's call it 64 even, plus $2.25. This thing can get to 66 and a quarter to the upside. So we still have plenty of available room to the upside, and that's what makes this such an interesting critical state to trade in, because we've made the case why a failure here would not be irrational in the distance it could travel. But then finding support, that case is even easier to argue, because we've had 60 days generally up. Volatility has been bad. The 270, which is the long-term fair value, has only begun to roll over. We had a nice gap up, and we haven't failed yet. So if it finds support at a rising VWAP, that's exactly where it's supposed to be. And then if we're able to get an entry somewhere in this area, let's say that it finds support in this area, and we're able to get an entry somewhere in here, somewhere in this area, then we still have a nice long move to go. Well, we would bracket the price here. We would put a price ladder here and say the first move would be to resistance level, and we'd be ready to execute our 2-hour battle drill to preserve that profit, and then place another entry just above that. So if it does break through that previous swing high at the top of the dragon, and then it's free and clear, that would be the first sign that we could have this large range stat move, and that's where we'd want to have our second position in, and then we could use the profit of the first position that was earned in this area in order to give us some risk management and to fund that second position. So let's clear the deck here and recap where we've been. Oh, let me first say while we're on here, the Bollinger Band framework. I just want you to notice that when we're getting this sideways quiet channel kind of an action, how tight the Bollinger Bands, the Z3 lines pinch, and we had another one of those pinches here, and so that tells you when you're about ready to have a significant move one way or the other, and we can actually play the breakout. So actually putting that Z3 pinch here would have given us the opportunity to get short, were we so inclined, right on this spike with the target of the VWAP, the open, the VWAP excursion, and then the closing of the gap. So we have 4 measured price levels that we could get on the way down. All right, so let's recap after we clear the deck. So now to finally review, all things being equal, then at 1:30, we're setting up a tight trade frame here where we're going to look to get long about 64.88. We would get short about 64.78, so there's about a 10-cent price range risk in here. And then on the downside, we would be looking for a return to the VWAP. If it breaks the VWAP, we'd get to no lose. I would look to consider adding a second position down here around 64.40. It's too tight in here to get any short. I really want to see it get past this congestion zone here where the open was. So if it gets below the open is where I would look to add a second position. On the upside, if we're long at 64.80, I would expect to see it come up and test the dragon hump here around, that looks like about 65.14 or 15. And then if it were to hesitate there, I'd be looking at cashing that position. If it gets up about 65.20, I would be looking to add that position. So that's the trade frame that we see intraday that takes into account time, will, pattern, and money. Now let's see what ended up unfolding later that day. Now as this trade plays out, I'm zooming in now to 1:30. This was the downward move that brought it within 10 cents or so of the VWAP, so at 130, and we set up our trade to go short at 78, to go long at 88, and this was our blue stalking line. And notice we already have a 1, 2, 3 here. Now there's my actual entry is here at about 64.90-ish. But I want you to notice a couple places that we talk about entering. One is when the RL10 crosses the baby dragon. Anywhere in here now, we have a favorable signal. So you could get in anywhere if you're aggressive in this candle. I would like to get in when it clears the high of the previous candle. So I would accept an entry there. Now the next thing that happens a couple bars later is the RL10 crosses through the dragon, and so it's possible to get an entry here or here in this next candle, and I don't mind that at all. That late in the day, and because we were in a pullback, I don't mind either one of those entries. The second or the third entry are fine. So we're in at 64.80. It quickly kind of moves in our direction here. Now I want to talk about position sizing stop. I recommend, as you're learning these techniques, to use a full frog box for position sizing. We saw that was about 58 cents. So call that 60 cents for position sizing. But because we have a place where we wanted to get short at 64.78, or even if you waited to get below the VWAP at 64.70, I wouldn't object to that either. But our execution stop is we're really only risking about 10 cents here out of our 60 cent position sizing stop. So we've actually capped the loss here with our stop and reverse at about a 0.16, call it 0.2, because we would stop and reverse if this immediately sold off and went below 64.78, we would be short. And so our actual stop management on this one would be, let's call it the VWAP. On this move where you have the nice bump up, that's a place where I would look to get to no lose plus dinner for 2, and I would pick up this stop and then start tracking either the 30 or the bottom of the dragon. I would even accept the PSAR and take this exit. On this one, when I notice that the RL10 is rolling over, and now we have the RL crosses the baby dragon, that's a reasonable place to get out. Now we have the RL10 entering the dragon, so I have to get out basically here and here. Somewhere in this box, I have to get my exit, so I'm going to get anywhere from 65.03 to 65.08. My actual exit was at 65.06, and so from 64.88 to 06 is 24 cents over a position sizing of 60. So this equals about a 0.4 R. And just playing within the ordinary non-controversial range moves, right? So it got most of the way back to the RL270, which you notice is still coming down. And as we're now at 2 o'clock, there's only an hour left in this trading day. I don't mind locking in that 0.4 R win, getting reset, and then moving on. So that's a typical trade quiz where we have established now this trade frame at the bottom in this low risk entry idea right here. This is the critical state right in here. We're able to have a reasonable move in either direction. We're paying only 10 cents of information for it to make a decision. Once it makes its move, we're expecting a larger move than that 10-cent execution risk, and so we have a critical state by definition. Again, there's a strong argument for a move in either direction. Now, in this particular case, it didn't quite get up to that RL270. It kind of stalled right in here where that previous hump was. So that's now starting to look like a resistance level, and we would proceed with the rest of the day accordingly. So that's describing the situation in RLCO terms and evaluating the scenario for possible trading opportunities. Now, this has taken me about 20 some minutes to talk my way through this, what you'll discover is as you adopt the framework and internalize this frame of reference, you can make that kind of assessment, in 10 to 20 seconds as you frame out reward and risk and time of day and slope of the regression lines and the width of the Bollinger Bands and the location of the VWAP. These frameworks repeat during the day. You get accustomed to looking through this perspective, and our ability to evaluate positions from a standard frame of reference makes this very low cognitive cost and easy to, not easy, but reasonable to make rapid decision frameworks during the day and minimize the cognitive load of making all these computations. So thanks for hanging in there. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.